welcome everyone to another Options Millionaire podcast. I'm your host, Peter, and I do not have my co host, Travis, with me for the next 10 episodes. So, this is going to be episode 71, and this episode is going to be a little bit different. Going forward, we are going to be doing, we're still doing a podcast, obviously. So you'll still be able to listen to it on your favorite podcast application. But we are doing video podcasts as well, and we're going to post them to our Rumble and YouTube page. So episode 71 is going to be the inaugural video podcast episode. So now I will cover everything in the regular podcast, but there's some folks that really like to have the visual aspect of things. And as I'm doing the podcast, for those that are listening, I will be literally showing different things on my screen. So you can listen to your podcast like you do on your way to work. And then when you come home from work later that night, you can always go to the YouTube page or the Rumble page and be able to actually view the podcast. So you'd get to see kind of the visual aspects of what I'm talking about. So how do you get to it? Simple. Just go to either Rumble or YouTube, either one, and just search for Options Wealth Academy, and you should find us. I will, of course, leave a link to both pages in the description. So for whatever app you're using for your podcast, there's usually a description on each of the podcasts, and I usually leave a link to both the Options Wealth Academy and other things, but I will leave a link to our new YouTube and Rumble pages, as well as if you can't find it or for whatever reason you're not sure, let's say you get to work, you don't have access to your Rumble app, but you can go on the internet, you can simply go to the optionswealthacademy.com and there will be a link to it there as well. Okay. So, in episode 70, the last episode I did with Travis, I talked about hopefully keeping you guys engaged. And so what I've decided I was going to do, because I think I get the most questions about this, both from students, clients, and from non-members, people that just listen to the podcast. So I'm going to start over the next 10 episodes. I'm going to cover a variety of option strategies that I trade and topics, as well as I may cover some option strategies I don't trade and go into a little bit of what I hear from students as well as clients and non-members that ask me different questions about other people's trading strategies. So in this episode 71, I am going to do covered call strategies. Okay. And so the first thing I want to do when it comes to covered calls is I want to start by defining what a covered call is. So, and for those that are listening, you're probably wondering what I'm doing. I am sharing my desktop. So for those that are watching, you'll get to see what I'm talking about, because I'm going to have my paper trading platform opened and go through a lot of these things. Now, you will see me do things on my Rumble and YouTube page, and even sometimes in the free course that we have, you'll see me do things on my paper trading platform. However, I do all the members of the Options Wealth Academy, both our programs, they actually see me trade in real money. Okay. So I trade my real trading account. And I want to do a sidebar real quick about the influencers you follow when it comes to trading. Okay. And when they show you their different trades. If you are a member of the Options Wealth Academy, anyone can tell you this. You're going to always see me trading. 99% of the times you're going to see me trading from my real money trading platform, because the goal is to show members how to turn a 5 or 10K account into 50 or 100K in 5 years or less. So I'm actually doing that in my real accounts. I'm not just preaching something I don't practice. I'm trying to do it. This is when I started the Options Wealth Academy. This is my goal was to turn basically a 10K account into 100K in 5 years or less. So I have till 2027. Am I going to reach that mark? I'm not sure. I didn't do so well in the first 3 years. So, but the point is, I'm very transparent with my students and my audience. I don't do things um, under disguise, and so I want to cover that real quick. What I'm talking about. If you look on the screen here, you'll see that this is my paper trading account, but I could also bring up my real money trading account. And actually, I'm going to do that real quick. Let me log into my real money trading account. Okay, so this is my real money trading account. So for those of you that aren't familiar with the Thinkorswim platform, or you don't have Schwab, you'll know when someone's using their real money account because it'll say up here connected real-time data in green. That's on the Thinkorswim platform. Now, I'm going to show you something on the Thinkorswim platform that I never knew existed until I joined this one course, in which until I joined this one course. And I noticed this guy had this weird feature and it's called on demand. So if you go over here and you click on the on demand button, which I'm going to do, this is what an on demand account will look like. Okay. So the first thing you will notice in the upper corner here, now this thing is buffering because it's pulling all the data. You'll notice it says virtual account. You can't trade in on demand for a real money account. The other thing I want you to pay attention. So today is January 24th of 2026. And I want you to look while you're watching this video, bring up your own trading platform and look at the chart. And you'll notice the chart on the screen is extremely different. So pull up SPY, look at the chart, and you're going to notice the chart on whatever day you're listening to this on is going to look totally different than this day. Actually, whenever you're listening or watching this video, I want you to pull up and look at the January 2024 or January 24th, 2025. Look at the chart time frame there. And you will notice that it looks very different to what mine looks like here. And that's because I'm on demand. One of the awesome, powerful tools of the Thinkorswim platform is it allows you to actually go back in time and trade in the real market on any day. So today is Saturday. Today is a Saturday when I record this video. But you will notice that the market is actually moving. If you look in the upper right-hand corner, it's based on September 18th of 2025, and it's 9:33 p.m. or a.m. And the market's actually moving. If I change this let's change it to a 1 day, 1 minute, you're going to see that things are actually happening over here. Okay. And that's what the on demand feature allows you to do. So, why do I bring that up? Because what I noticed is, especially when I look at all these different influencers, I noticed that they're always on this on demand feature, especially when they're showing us their profitable trades. And you got to ask yourself, why wouldn't they show me the real trade? Why wouldn't they do that? Now, some people might say, oh, well, they want to, mask their account identity, the whole 9 yards. And yeah, that doesn't make sense to me because we record these videos. So when I edit it, I can mask all the things I don't want people to see to be able to steal my account. So that doesn't make sense. The other thing is, um, in my opinion, if a person's not trading on their real money account or showing you the trades on their real money account, I'm not claiming anything about them other than ask the simple question of why would they not do that? The privacy thing doesn't fly with me because as I show all of my students, I show in my real money trading account. I will do trades in my paper trading account from time to time when I'm showing someone an actual, like I want to explain something. I'll do it in my paper trading account. I don't want to do that in my real money account because those are for real trades and it's real money. But in any case, I did want to just kind of go into that. So if you have the Thinkorswim, you can do that on demand. You will notice in all my videos on the members website, I'm in my real money account. So when you look over here now, these are actual no BS trades. This is all real. The difference, again, let me show you the difference between real money and paper trading. And you can see the paper trading account clearly shows simulated trading up here. Everything else looks exactly the same. It'll say green, it'll be green connected real-time data, but it says simulated trading. That's how you know it's a paper trading account. So even some of these influencers that don't show want to show in their real money account, well, then why not show in a paper trading account? It just doesn't make sense to me. So I did want to cover that real quick. Okay. So let's go into defining what a covered call is. So a covered call is where you're going to sell a call option on an underlying security in which you own. Okay. Now it's important to understand that you have to own the shares of the security that you're going to sell the call on. If you do not, it is not called a covered call. The name is the definition of the name is all there. It's covered by the shares you own. When you sell a call option, if you do not own the shares, it's a naked call. Okay. And we don't ever trade naked call strategies due to their risk parameter. So now, now that we defined what a covered call is, let's go into the actual strategy. So in my opinion, there are definitely wrong ways to trade cover call strategies compared to smart ways to trade cover call strategies. But I'll be honest with you, I see folks chase the illusion of huge returns on cover calls while forsaking the risk that comes with the strategy. And so let me show you what I'm talking about. So looking at my paper trading account, and those listening, you just have to visualize this. In this paper trading account, you can see I own 100 shares of SPY. So, and my trade price is 665. The current market is at 688. So if I go into the trade tab and let's say I want to sell a 1 week covered call here. So I'm going to pick the 30 January covered call. And I always trade at my purchase price. Okay. So remember, my purchase price was 665. So I want to trade a 665 covered call. Now that's going to be way in the money here. You see how it is $24.58. And for those listening, you just have to take my word for it. That means if I sell this, I'm going to generate a credit of $2,400.58 over a given week. Okay. Now that's because I own SPY at 665 in this trading account. But what if I owned SPY at the current market value of 688? Well, let's look at that trade on a weekly. So let's say today is a trading day. It's Saturday as I record this, but let's say it's a trading day. And I buy the shares at 689.23. Well, I don't want to sell the 688 because I will lose $1.23 if I'm assigned. I always sell the strike that is above my purchase price. Okay. So this is considered an at the money covered call. Okay. Because I'm going to purchase the shares at 689.23 and I'm going to sell a 690 because it's above it. I'm going to then make $4.51 or $451. Okay. That's an at the money cover call. That's how I trade my cover call strategy. However, there is another way to trade it, and it's called out of the money cover call. And an out of the money cover call, let's use that same example. We buy our shares at 689.23, but we want to capture some capital gains, meaning we expect the market is going to go up. Now, how much is it going to go up? I don't know. I will show you what some of my students and clients do. They will actually just go 2 to 3 steps above what they paid for the shares. So if they paid 689.23, they'll round that to 689. And then they'll go 3 to 4 steps out, but they're looking to generate, let's say, $2 to $3 in credit. So they will look at this 693. So let's look at the 693. If we sell the 693, we're going to generate a credit of $2.97. However, we also have the potential of generating another $4. Why? Because we bought the shares at 689.23. It would really be $3.67, but let's just round it to $4 to make it easy. And how is that going to work out? That's going to work out based on how the market moves. If the market is at 693 or higher on expiration day, the broker is going to assign you. It's going to assign your shares out. It's going to sell them. Okay. That's why it's called a cover call. So it's going to sell them. So your initial credit of 297, you keep that. You always keep that. But then if you get sold off at your strike price of 693, you will then make an additional $3.67 or 367 cents for a total of, let's just round these numbers, you're going to make $7 in essence, as opposed to what I do where I sell the 690, I'm only making 450. Okay. So that's the difference. That's an out of the money. And then there's the in the money cover call, which I think is preposterous. Why would you ever do an in the money? It doesn't make sense. And let me show you why. You would do it in the money if you were going to sell at your purchase price, but you could easily do an at the money and make the same amount. Why? Because remember in my original, I showed you my share price was 665.90. So let's just call it 666, right? If I sell the 666, I'm going to generate $23.57 or close to that, like 24 bucks. If I sell the at the money of 688, I'm going to generate 574 plus I'm most likely going to be well, there's no guarantee I'll be assigned, but if I'm assigned, if the market's above 688 a week from now, it's going to sell off at 688. So if I take 688 minus my 666, I'm going to generate another $22. Well, 22 plus the 570 is going to be $27.70. Well, you can see if I sold the 666, that would be 23. So I'm actually going to make more by selling the at the money. Okay. So that's an in the money cover call. Now, the reason I never do in the money is because I'm constantly trading this. If I'm selling cover calls every week, a lot of times, depending on what the market's doing, if the market's going up, I'm getting assigned a lot. So I'm always purchasing back my shares at the current market price. Okay. And so I'm never going to sell an in the money because anytime you sell an in the money, sure, you get a higher premium because you're risking your share price. If you bought your shares at 689 and you sold, let's just say, a 684 covered call, yeah, you're going to make $8.63, but you're going to lose $5 when you get assigned because you bought them at 689. They're going to assign you at 684 if the market's above your strike price. Okay. So I never trade an in the money cover call, but that's basically how they work, right? So just to kind of recap, an at the money cover call is when you sell a strike at the current price of your shares. So whatever you purchased your shares for, you're going to sell the strike that's closest to it. I always go to the strike that's just above it because you never get your shares typically. I shouldn't say never, but it's very rare that you'll buy your shares at like the market's at 689.23. It's rare you'll get your shares at 689. You might get them at 690 if you decide, hey, I'll give you 690 and they're trading at 689.23. Sure, the broker may fill that order. But even when I've done that, a market order, or if I've said 690, the broker may just assign me at the 689.23. So in any case, I always sell the strike just above. That's usually at the money for me. Okay. In the money is when you sell a strike price that is below your purchase price of your shares or below the current price of the security. That's an in the money cover call. And an out of the money is when you sell a strike price that is above the purchase price of your shares or above the current price of the market. Okay. So that's pretty much the in the money, out of the money, at the money. Now, the next thing you got to do is determine what your strategy is going to do or is going to be. So as I showed you you have three defined strategies for selling covered calls. You can sell in the money, at the money, or out of the money, right? For me, I always sell at the money. Okay. The reason I do this is because the at the money, out of the money strategy, there is zero risk involved. You never risk anything. If you buy your shares at 689.23 and sell at 690 or higher, you can never lose money. If you're assigned, you're always going to be assigned at a price over what you paid or at what you paid. So you can't lose any money. So I always do the at the monies because they give me the most guaranteed premium. Okay. I like to know what my consistent monthly income is going to be. And I don't want you to confuse that with a specific dollar amount. So, for example, on average, I get about $3.50 for every covered call I sell. And I'm usually doing 7-day covered calls. So, as you can see, there's not a 7-day covered call showing on the option chain right now. And that's because it's a Saturday, right? And actually, do we have a holiday coming up? I don't know if we have a holiday coming up, and that's why. But in either case, um, if I can't do the 7, I do the 6, right? So just looking at a 6-day covered call, and at the money 6-day covered call is showing $5.74. That's extremely high. It's not typically there, but it's high because the market's closed right now. And so the market closed at 689.23. But if you look at after hours trading, is showing it at 687, 688, the bid ask spread. So the numbers for the options are a little off. Okay. So generally, an at the money cover call for me is somewhere in the $3 to $4 range. Okay. And so when I do that, I'm guaranteeing I make $4. Okay. So that's how I trade it. However, I told you about out of the money cover calls, and this is for, I have quite a few students that don't like getting assigned and seeing the loss in capital gains. And what do I mean by that? They buy the shares at 689.23 and they sell a 690 covered call. And then at expiration, 6 days later on the 30th of January, the market's at 695, and they look at that and say, I just lost $5 in capital gains per share. And if I own 100 shares, that's $500. And they don't like that. And so what they do is they say, okay, well, let me try and find a kind of happy medium there. And so some folks do a calculation. They say, well, I think the market's going to move up X amount of percent. And they do that calculation and they sell that strike. Others, which is a much easier system, they say, well, I want to at least generate $2 in premium. So then they'll look for an option, a call option that is going to generate $2 in premium. And then that's their strike price. So in this case, looking at the option chain, these options are a little off, but if you look at the option chain right now, the strike price that's going to generate $2 in premium is the 695. So that's the one they would sell. Now, here's a caveat to that. They are going to make potentially much more money than I will selling the at the money. However, my income is guaranteed when I sell the at the money. If the market doesn't move anywhere and on expiration day it's below my strike price, uh, there's no harm, no foul. Whereas if you sell the out of the money for that 695, yes, you have the potential of generating another $5 in return in premium. But if the market's at 694 at expiration, you don't get assigned. And so you only guaranteed $2.16. So that's really the difference there. Okay. When you sell an out of the money, you're guaranteeing the initial premium with the potential of more, but that's always going to be less than the guaranteed at the money option. Okay. When I sell an at the money, I get $5 or $4 and I don't recoup any capital gains. But if the market goes down in that week, I don't lose out on potential income, whereas selling out of the money you do. Okay. Now, I want to call into question something I get a lot. Someone asked me a question. Actually, I've been asked this twice now. Can you generate 1% a week on covered calls? My answer to them is, yeah, of course you can. With SPY, no, you can't. Well, I'll let me qualify that. You can, but your risk parameter goes significantly higher. Okay. So what do I mean by that? So what they're doing is there's a lot of influencers out there that will show a strategy in which they say that they generate 1% a week. That equates to 4% a year or 48 or 4% a month or 48% per year. Is it possible? Absolutely, it's possible. Nothing's impossible when it comes to investing and trading. However, when you're looking at these things, the first thing you should ask yourself is, what's the risk? Okay. Now, with a covered call strategy, the way I do it, there's no risk. But here's the caveat. When someone asks me, can I generate 1%? Now I generate about 1 to 1.5% per month. Every month? No. My average is about 1%. When I take my total income for the year and divide it back over 12 months on the cover call strategy, that's been about my average. It's anywhere from 10 to 12% a year, which equates to about 1% a month, right? But is it always 1% a month? No. Consistent monthly income means that I consistently generate income. Now, I want to show you something. And for those listening, you'll just have to hear me out here. For those watching, you'll get to see this. Let me show you my spreadsheet for my cover calls. Okay. So you can see, let me get to it here. This is my income for covered calls. Now, mind you, these are weekly covered calls. Ah, I forgot to put my newest one in here, so I'll show you that. So the first week I generated $1,300. The next week, 700. Now don't mind this because I'm doing something, but in essence, 700 the next week. And then the week after that, 1,500. Okay, so you see how it fluctuates. Now, if we look down at the bottom, my total credit I've received minus my fees is $2,617. That's about a 0.5%. Now, this is as of my trades up to the 20th of January. So there's more in here. But this is going to equal about 1% when we're done. I got to put it in here. So, but I want to point out something, and I didn't put it on my spreadsheet. So let me go over to my trading platform here and show you what I'm talking about. So let's go. And for those listening, I apologize, but let me go to it. So let's look at my current covered call here. I have a 696 covered call. If you notice, the trade price is at 47 cents. So remember, if looking at my spreadsheet, my average is about $3, $3 to $4. You can see that here. Every once in a while it drops, and this is when the market is dropping. And this latest one, as you can see, is 47 cents. Why so low? Well, because the market was no longer at my purchase price. Okay. I purchased my shares at 695 and change, right? You can see it here, 695.37. So I sell the 696 covered call. Well, if the market's depressed, which it was, you're not going to get the same premium. But I'm getting consistent monthly income. What was my consistent monthly income for this week? It was 180 bucks. That's basically what it was. Almost $200. So that's consistent. It's just not consistently $1,500. Okay. Just make that clear. Now, the next thing I want to talk about is cost basis. You will hear people talk about selling covered calls at their cost basis. This is something that makes zero sense to me. And let me show you why. Here's what they do. If they buy their shares at 695.37, let's say, okay, every time I sell a covered call, so let me bring up my calculator for those that are listening. I'll explain this. So let's say I just sold a cover call and I got $4 for it. Okay. That's my premium, $4 times 100 is $400. Okay. Because remember, every contract represents 100 shares. So I generated $400 in premium, right? But I really generated $4 in um, towards the if you wanted to look at my cost basis, right? So here's how it works. If I pay $695 for my shares, okay, 695 for my shares, and I generate a premium of $4 for a covered call, that $4 really translates to 40 cents to take off my purchase price. Okay. And that would be my cost basis. So I paid $695. I sold a covered call for $4. That, remember, each option represents 100 shares. So that $4 really translates to 40 cents per share. Okay. So if I subtract that 40 cents from my purchase price of 695, my cost basis is 694.60. Okay. Now, here's why this is important to understand, because this is what I see a lot of folks do. When you first start your strategy, especially most times we're in a bull market. So you're just going to be constantly being called away, buying back, selling a cover call, called away, buying back, selling a cover call. This is generally what happens to me, depending on how strong the bull market is. But now imagine we've gone, I'm going to say 5 months of selling covered calls. Remember, each week we were making 40 cents towards our purchase price, right? So each week was 40 cents. Let's multiply that times 4 times a week. That's $1.60. And let's say we've done this for 5 months. So I'm going to multiply that times 5. Now we've generated the equivalent of $8 in cover call premiums towards the purchase price. And this is what folks will do. They will take all that. And so they bought their shares at 695, okay? 695, and they will deduct $8 because that's what they've generated per share in covered call premiums. And now their cost basis is 687. And the reason they do this is because when the market goes down like it did the other day. Look, the market went on January 16th. It opened at 693 and it closed at 691. And the very next day it opened at 681 and closed at 677. Well, if you're trying to sell a 695 or 696 cover call like me, the premiums are garbage, right? You have to go much farther out. So what these influencers will tell them is like, no, don't worry, sell at your cost basis now. So now they give them the right to sell at 689 because that would the market's at, well, the market was at 681. So they give them the green light to go ahead and sell at 681 because you're not going to lose any money because your cost basis was 687, right? Or all right, so let me rephrase that. They'll tell them, go ahead and sell at 687 because that's your cost basis. So if you get assigned, you don't lose any money. And that's entirely true. That's absolutely correct. Except you just gave up all your premiums from the previous 5 months to do that. Okay, understand that. If you use cost basis, it means you're taking all the premiums you get to keep. This is booked profit, and you're putting it into a trade that is going to lose it potentially. And that's what ends up happening. So when this, and make no mistake, I've seen this talked about by influencers quite a bit where they'll say, no, I'm always making 1% because I'm always selling at my cost basis. And it's like, well, you're not then, because any percentage you made prior to being assigned, when you sell an option at your cost basis as opposed to your purchase price, the minute you are assigned, that cost basis was based on profit you made. That profit is gone now. Okay. This is basic math. Okay. So just understand that. When it comes to a cover call strategy, I don't guarantee to anyone that you can make 1% a month. I don't guarantee that to myself, other than that's my average. So that's how I do my cover call strategy. I don't guarantee I'm going to make 1% a month. That's just been my average over the years that I make about 1% a month. There are going to be times when I don't make anything. As a matter of fact, if you look at my spreadsheet for members that have looked at my spreadsheet, um, you can look at my spreadsheet from the beginning of 2025, and you will notice that in January, February, and March, I made like $200-300 a month. Well, that's not 1% of that account. And so, but then you get into other months where I made well over, there was one month I made, I think, 11 or $12,000 in cover call premiums. That's not the average. The average is about 6 to 7 grand a month. And so when you get to the end of the year, when I get to the end of the year, I tabulate it all out, and that's what it shows me. Hey, you made about 1% a month. So that's it, you guys. That's the cover call strategy. That's my cover call strategy. We teach this in our Options Wealth Academy 2.0. I will put a real quick snippet in here or caveat about our programs. 2.0 is for people that have 6 or 7 figure accounts. I get this question a lot. Folks that listen to the podcast, they come over, they want to learn like the cover call strategy. And so they usually ask me, hey, can I just join 2.0 without joining 1.0 first? And the answer is yes, but it's not my recommendation. And the reason for it is because in 1.0, first and foremost, we give you a 30-day free trial. What if you don't like what I teach? Well, 2.0, you don't get that refund you don't get that refund, and it's just because of that blueprint. And sorry folks, I've been scammed by folks in the past where they've joined. This is why 2.0 is an annual fee, not a monthly fee. I've gotten people that unfortunately have joined my program just to get the blueprint because they already are options traders or investors, or in some cases financial advisors, and they've taken my blueprint. I can't guarantee, or I'm not exactly sure of this, but why would a financial advisor join my program for 2 months and then leave? You can't learn something in 2 months. I'm sorry. That's the one time I'll say can't. Try it. You'll think you've learned it, but you won't have learned it. Any options trading strategy, investing strategy, anything that is going to make a large sum of money, um, it takes years to develop that skill set. And so if you join a program expecting to master a skill set in 1 to 2 months, I don't think you can do it. I've never seen anyone that's been able to do it. You can do it in the first 2 months of a bull market. Sure. You can think you've mastered that template, but then the minute the market crashes or goes down, you suddenly find out you can't. And the reason I know this is because a lot of folks come to me that have taken other courses or have been trading options trading strategies for a very long time. And the story is almost always the same, where they're like, I've lost so much money trading options. I need a program to help me get over the fear of trading options. And um, so in answer to your question, no, I don't suggest you join 2.0 because when you join 2.0, there's no refund, and you're going to pay $2,200 right off the bat. And you're going to waste your money if you find out you don't like my teaching style. Okay. Or you don't like what I stand for. Because I'm not a day trader and I'm not a get rich quick kind of guy. I don't believe in that. I believe wealth is created over many multiple of years. And anyone that creates wealth in a short period of time loses wealth in a short period of time, because that's how money works. Okay. So I just wanted to kind of throw that plug there. If you're interested in a covered call strategy, you need to learn our basic core strategies first, because they, number one, teach you the most fundamental and important thing, and that's risk. So you need to join my 1.0 program first. The best news is you can join for free. 30 days, you get to go through the entire program, look at it, and then if you don't like it, you just cancel your membership. You don't pay a dime. And if you do like it, which I think most people do, then you pay the annual fee. And then once you've gone through and you've got a solid foundation from our 1.0, you can then go over to 2.0 if you have a 6 or 7 figure account. So, all right, that's it, you guys. That's a wrap on today's episode. And I didn't make out my schedule for the next episode. So 72, I'm not exactly sure what it's going to be yet. I this one I wanted to talk about first, but I'll probably get into maybe some of our credit spread strategies and cover some of those things. So that's it, you guys. You take care. We'll see you in the next episode. Bye bye.